The Fed is starting quantitative tightening, which I'm happy for because today I think it gave me a legendary introduction. Quantitative tightening is when the Fed takes money outside of the economy at the rate of about 95 billion per month is what they are doing. So Justin, when this happens, obviously liquidity leaves the market. Stocks are supposed to go down because there's less money. But is this already baked in? And do you think stocks are going to be affected by this?
I think QT is baked in. I think we all expect it. I think rates being raised 50 basis points, at least for the next few meetings, is all baked in. I think what is not baked in is a steeper than expected recession and stagflation. I think that's the fears. And so everybody's really looking at inflation. And so, I mean, I don't think that I'm afraid of the markets when the Fed starts QT, because I think that, like, why do you think we're all down so much year to date? It's because we know it was coming. The markets are future looking. If you remember how the markets behaved through COVID, it's all very future looking.
Tom, what are your takes on QT and how do you think it's going to affect stocks?
So here's the thing. I think that this is a really important point because QT is a critical part of waging war against inflation, which often gets overlooked. We talk a lot about raising interest rates as a tool to battle inflation, and we almost never talk about QT. But QT actually ties very nicely to the previous segment where we talked about giving people too much money. When there's too much money in the system, interest rates increase are not that helpful because essentially capital isn't scarce, capital isn't expensive, and then the party goes on. So if you want to get to the end of the cheap money era, the party is over kind of narrative, you absolutely have to be more aggressive on QT. If that is in fact where the Fed is headed, which it seems like, it reinforces the theory that the current bull market mini run that we had is very, very temporary. Because QT is, if it continues, I agree with Justin, so far already be priced in, but if it continues in this path, there's going to be more pain ahead for the stock market. It's the combo between that and elevated interest rates is going to be very painful.
Can one of you break down what exactly is the difference between quantitative tightening and quantitative easing? Like what happens from a macroeconomic perspective when the Fed does either?
I'll do it really quickly because I'm not that smart. I'm not as smart as Justin, so I can explain it in normal language.
Okay, we
explains it. Look, shut the fuck up. Listen, 30 seconds explanation. In QE, what the Fed does, it buys assets in the free market, mortgage-backed securities and bonds. Putting money in the market, buying up bonds, creating demand for the bond. Demand goes up, what goes down? Yield goes down. We talked about it, right? So on the opposite scenario, the Fed is basically saying, I want to take money out of the market, okay? If they want to take money out of the market, they're selling bonds, selling mortgage-backed securities, taking money away from the market, pushing the yield up. That's the whole story in 30 seconds. Understand?
Okay, pretty fair.
If Justin would have had to explain this, it would have taken 45 minutes. There's a good part of not being as smart as Justin. I can explain things easily. You see this?